Guys, let's talk a bit about using different time frames here on our charts and the advantages and disadvantages to each. Now, keep in mind our goal as traders is to simply grow our accounts. That's the only thing we should be concerned about. Don't care about catching every move and participating in every trend. Our job is to steadily grow our accounts. And in order to do that, we need to make sure that we are risking our capital on the truly, fruitful opportunities and having, to the best of our abilities, the power to say no to a lot of other subpar opportunities. And one thing you can really do to, better the odds of only placing trades in, a true move is by using volume. Now, all of you guys who have been longtime members, you've seen all my videos, volume is a huge part of my strategy. For you newer guys, volume is these bars down here, and it's simply a measurement of how much money is coming into a stock or a sector. So you look up here on XLF, big time money came in here, big volume, and that's when the move began. On the low volume here, we have gone nowhere. So for this discussion, let's talk about the different time frames. Now, I prefer personally to use higher time frame charts, such as either a daily chart, a 195-minute chart, or a 65-minute chart. For placing my trades, I really like to use the 195, and here's why. First off, 195 minutes is half of an 195 minutes is half of an entire day's session. So 2 bars makes up an entire day. So it is about 11 o'clock in the morning here on Thursday. Here's the opening bar for Apple. Here's why I like to use this chart, guys. It takes true institutional buying power here to make moves on a 195-minute chart. So kind of looking across the board here, you can see that, money was coming into the markets, it flowed into tech names, big volume in Apple, a big move. Big volume in Amazon, in Tesla, big moves. Boeing, big move. So volume is what moves stocks. We get that. In order to be able to say no to a lot of, moves and truly wait for those fruitful opportunities, for me personally, using these higher time frames has allowed me to stay out of the noise, is what I like to call it. When I use these higher time frame charts, I often tend to trade much less, and when I do trade, they're pretty powerful moves. So here's why I like the 195, guys. And just for this example, I want to compare charts. So here we are, last few days. And again, these bars are half a day's session. And we've gone nowhere. Very low volume. Apple's gone sideways, has not moved. So, by looking at the 195, what do we see here in Apple? It's in a nice consolidation right now on super low volume. That's what the big picture is telling us. What if we take a look at the 65-minute chart, though? Now we're seeing a little bit more. Now we're kind of seeing these, up, down, the dips, the fades that you really don't see on the 195. Again, this requires more data. So see how kind of quiet and how low the volume is there, guys, and it's really gone nowhere. We pull up the 65-minute chart now. And what you'll see is that because each bar is now only 65 minutes and it's taking in that data, we've had quite a few volume spikes here. There was a nice volume spike. There was a nice volume spike. There's another one now. Again, volume applies on any time frame, guys. If you're looking for a quick in and out, volume is still a good indication of where you should be. But again, just do that comparison one more time. Nothing, right? 195, nothing. Low volume, nothing to be done here on Apple. Look at this 65, and now you're like, oh, okay, we've got some buying coming in here. Things are looking hot. What if we jump down to a 30-minute chart? Each bar is 30 minutes. Now there's a lot more little increases in volume here that we're seeing, guys. Flip down to the 15. You got volume coming in all over the place. Dips, fades, and we'll take a look at the 5-minute chart. So look at that mess. To me, this always fascinates me. Here is the 195-minute chart for Apple. Consolidation, guys, nice and quiet. No trades here to be done if you're a swing trader waiting on that volume. You go down to the 5-minute chart, and it looks like, holy shit, what's going on here? You got spikes, you got all kinds of crap. This is what I wanted to discuss today, guys. On the lower time frame charts, you're going to get a lot of noise. And what that means is you're going to get, massive flows of volume on such a low time frame, quick moves that, if you're looking at a 5-minute chart and you see Apple do this, a bar like that, you're thinking, hey, we're about to make a move here. But in reality, take a look at our 195, this spike and that spike and that spike and that spike, they meant nothing. We're still in the same range. So for the purposes of avoiding, those not perfect opportunities, to have the ability to say no to more trades and, truly wait for those big time, fruitful, group move opportunities, this is why I suggest using the higher time frame, guys. It's going to keep you out of the noise. You're going to see less. Let's take a look here at our sectors today. There's nothing going on in tech, nothing in financials, nothing anywhere, right? Even in energy here. Now, energy's up almost 2% on the day, but look, guys, there's no volume coming in. There's no big boys on Wall Street buying energy right now. Take a look at our names here in energy. Same thing, Okay, so Exxon is up almost 2%. Am I going to chase that? No. Don't focus on that. Focus on the price action and the volume. Big money is not rushing into Exxon right now. You can see that. It's evident. It's not rushing into Chevron or into EOG. If I make these all 15-minute charts, guys, oh shit, now look. Now it looks like, a hell of a move is about to start, a big time move, because we're talking 15 minutes here, not 195. It doesn't take much of these bars to start to get moving, but we want to participate, or at least I do, in those big moves, guys. I'm truly trying to get to the point where I trade once a week, 2-3 times a month, whatever it takes, and I want to take, $10,000 to $15,000 position sizes. Those are the kinds of opportunities where in a week I'll be able to make anywhere, I put 10 to work, I can make 10 to 20 grand. Put 20 grand to work, you're talking 20, 40, 50,000 in a week. That's what I'm waiting for, And using these higher time frames, it keeps you out of that. But you flip over here to something lower, now there's just a lot more noise going on. And what I mean by noise is there's a lot more shit on the screen that'll make you act. But in reality, buying this dip meant nothing if you held it because it went nowhere. So these bigger time frames, guys, they allow you to see the picture. And, the last example here is Apple. Apple is up 1.6 right now. For many of you, I'm sure that drives you nuts to see Apple moving. But let's start from a low time frame and work our way to the big picture. Looks like we've got a lot going on there. Now it's kind of just a little consolidation with some pops. Starting to tighten up now. And then in reality, on the big picture, absolutely nothing is going on in Apple. Take a look at the main chart, the daily chart for Apple, and look at that volume, guys. So Apple's up almost 1.7%. Here's the daily chart. There's our volume bar for the day. Do you think this is the beginning of a move like this, where there was a week of consecutive days of buying, and that's where you turn 10,000 into 50, 60 grand? That's what I'm waiting for. I have 10 trades like that in a year, and I'm good to go. That's what I'm looking for. That kind of volume is a lot different, guys, than this. Now, can Apple continue higher here tomorrow? Of course. But again, the goal isn't to catch every single move. The goal is to grow your account and in a managed way, identify these opportunities. For me, this works, so I thought I'd share that with you guys. Try bumping up your time frames. You're going to get pulled into a lot less trades, and it could be very helpful. All right, guys.